In this video, I'm going to introduce you to some of the indicators initially presented by J. Wells Wilder Jr. in his groundbreaking book, New Concepts in Technical Trading Systems. These indicators have stood the test of time and can now be found in nearly all charting packages, including the one that is a part of your MT4 trading platform. Developing any one of these tools would have earned Wilder a well-deserved position in the Technical Analysis Hall of Fame. Presenting so many groundbreaking tools in one publication was a remarkable achievement, made all the more impressive by the fact that the book was published in 1978 and Wilder was using these tools long before computers were available to take over the repetitive calculations. The first indicator we will look at is the RSI, or Relative Strength Index. This indicator is an oscillator that ranges between 0 and 100. The relative strength is derived by dividing the average of up periods by the average of down periods. The default for the average is 14 periods. Once the indicator moves above 70, it is regarded as being in overbought territory, while a drop below 30 is regarded as a move into oversold territory. Wilder also recommends looking for signs of a failure swing to indicate potential turning points in the market. As you can see, during a period of bullish price activity, the RSI tends to gravitate toward higher levels, and during a period of bearish price activity, the RSI tends to gravitate toward lower levels. Obviously, this means there is less chance of the RSI giving an oversold signal during an upward trend, and less chance of an overbought signal during a bearish phase. To overcome this, a gentleman by the name of Andrew Cardwell recommends shifting the overbought and oversold levels. During a bullish phase of activity, he recommends using 80 as the overbought level and 40 as the oversold level. Similarly, during a bearish phase of price activity, he recommends lowering the overbought and oversold levels to 60 and 20 respectively. The average true range, or ATR, was introduced by Wilder in his discussion of the volatility index. As this diagram from the book shows, the ATR is the greatest of the distance from today's high to today's low, or number 2, the distance from yesterday's close to today's high, or thirdly, the distance from yesterday's close to today's low. By default, this indicator is averaged over 14 periods. As you can see on this chart, it provides an indication of the volatility of the market. Obviously, the indicator is higher when the volatility is greater, and lower when the volatility is also low. The Directional Movement System, or Average Directional Movement Index, is one of Wilder's most impressive creations. In addition to providing buy and sell signals, this indicator will help you to determine whether or not a particular market is trending and whether or not that trend is strong. The directional movement for each period is either plus or minus. The example on the left shows plus DM, measured as the distance between today's high and yesterday's high. The example on the right shows minus DM as the difference between the low of today and the low of yesterday. If the current day is an inside day, the DM is 0. And if the current day is an outside day, then the DM, or directional movement, is based on whichever direction had the greatest movement, either plus or minus. The plus DI and minus DI plotted on your charts are derived by adding together the directional movement figures for the past 14 periods, or whatever period you choose to use, and dividing by the average true range of prices over that same period. When the plus DI is above the minus DI, price gains are outstripping price falls. The ADX line is calculated by dividing the difference between the plus DI and minus DI by the sum of plus DI and minus DI, then averaging this over 14 periods. There is a further enhancement called the ADXR, which uses the average of today's ADX and the ADX of 14 periods ago. According to Wilder, a long position should be taken when plus DI crosses above minus DI. The position should be reversed when minus DI crosses back above plus DI. As a rule of thumb, he says that the system will be profitable when the ADXR has a value above 25. There is also an extreme point rule. This stipulates that on the day that the minus DI and plus DI cross, the extreme price level of that day should be used as the reverse point. As you can see on this chart, we would have been holding a long position during this phase of the market because plus DI was above minus DI and the ADX was above 25. Now we had the crossover here when minus DI crossed above plus DI. If we open up the data window, we can see exactly when that crossover took place. Now on this day, if we look in the data window, we can see that plus DI was still greater than minus DI. So the actual crossover took place on this day. This was the day when minus DI rose to be above plus DI. So according to the extreme point rule, the low of this day becomes the reverse point for our long position. But as you can see, the prices subsequently rallied again and our long position remained intact. This is a powerful indicator that is definitely worth further study if you want to use it in your trading. Finally, we'll have a quick look at the Parabolic Stop and Reverse indicator. As the name suggests, this is a trading tool that will keep you in the market at all times. When a long position is indicated, the stop and reverse level is plotted each day below the current price action. The use of an acceleration factor means that this tool accounts for both price and time in its calculation, resulting in the parabolic shape of the curve that gives the indicator its name. When prices drop to hit the stop and reverse level, longs are closed out and replaced with shorts, and a new stop and reverse level is plotted above the current prices, level with the highest point achieved during the long trade. When prices bounce during a short trade and hit the stop and reverse point, the shorts are replaced by longs and the new initial stop and reverse point is plotted level with the lowest point achieved during the short trade. You can find more information on all of these indicators by coming to the main menu at the top of the screen and clicking on Help, then Help Topics. This will open the User Guide window where you look in the column on the left hand side and click on Analytics and then Technical Indicators. Then you can scroll down to find details for each of these indicators. We hope that you found this introduction to Wells Wilder's indicators to be interesting. If you have any questions about these or any other indicators, please don't hesitate to contact our Global Trade Support team. They are standing by 24 hours a day whilst ever the market is open, ready to take your calls and answer your emails and help you out in any way that they can.